Hey, good morning, everybody. Good afternoon, I should say, to most of us. Just turned into the afternoon here in Chicago. How's everybody doing? Thank you for coming here. You are here with Mike Shorr. I'm filling in for my good friend and our CEO, Scott Bauer. Mix things up a little bit. Just want to make sure that you guys can see and hear me. You should see the subscribe and the smash that. And hopefully you can hear me. If you can, just give me a thumbs up or all good. Randy says we're good. All right. Good, 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 good. So if you like what you see here, going, not just talking about today, but please subscribe. Please smash that like button. That really, really helps us. And all right, well, let's get started. So what are we going to talk about today? I like this graphic, risk and roll. We're going to talk about rolling options. All right. Okay. So when we are rolling options, we want to take a number of things into consideration. Oh, let me get rid of that. We don't need to hear that, Mike. There we go. Okay. So typically we are going to be looking at things to roll before the expiration date. Sometimes we might get, something might happen in the market and we roll something on expiration, but we're going to be doing it before the expiration date because that will take the decay out of our kind of risk silo, and it allows investors will capitalize on any remaining extrinsic value, right? You don't want to roll something that's worthless. Okay, choosing the right strike price obviously is crucial. It should align with the investor's expectations for the underlying asset and their risk profile. Now, rolling options typically is not free. And we're going to talk about that in a second. It involves additional transaction costs and possibly a debit or maybe an additional credit to the business, depending on what we're talking about here. And then we have to know about what our feelings are on the current market conditions, volatility, trends, and determine the potential success of the roll. So one thing that I want to emphasize is that a lot of traders, mostly new traders, but even some older traders, let's say more seasoned, will just say, if a trade goes against us, well, I'll just roll it. Meaning that I will push the strikes out, maybe buy more time, whatever it is. That's not when you want to roll. You want to roll when you have the cards in your hand, because when you are just rolling out of a losing position, unless you have a really good reason for it, you are either adding to your risk or adding to your capital at risk, or maybe even both, and putting off the inevitable. Right? We know what our risks are when we get into a trade. We know what the rewards are, but we're not necessarily, well, no, we are looking at the rewards too. But what you don't want is to put off that inevitable. You have a losing trade. That happens. Good trades, you'll hear me say this all the time. Good trades make money. Bad trades sometimes make money. Sometimes good trades don't make money. But what you don't want to do is turn a potentially a losing scenario into a big headache. you're better off from a risk management standpoint of cutting bait and find a better opportunity. Everybody gets so focused on the trade they have on and trying to make it profitable. You have to accept the risk that sometimes we lose money when we trade. Cut bait and go. Don't start throwing bad money or good money at bad just to try and salvage something that, it's just not working out. Sometimes that happens. Okay, does everybody understand that? And that's one of the main focuses that I want to talk about today, is that rolling is not necessarily, the cure-all to anything. But when you hold the cards, and we'll go over some examples here, then it can be, rolling makes sense. But rolling out of a disastrous position, all you're doing is adding more money or adding more risk. All right? Stick with me here. All right. So the mechanics of rolling options. We can roll options. We can roll our strikes. We can roll the time. Those are the two main things that we're going to be able to do. We can either, is anybody in our VIX position? I know OV has it, and I have it over here in STO. So we rolled our strikes out, right? Or well, we did two things. First thing is that we bought February VIX. And then we rolled it to the March, 1822? So we are in an advantageous position. We hold the cards. We have a profitable position. Now, how can we look at that? One, we saw a lot of inflow in upside buying in March, April, June VIX. Okay, so let's go with that. And so we decided that we rolled out not only in strike, but in time. Right? We rolled from the 17.5, 21.5 in February to the 18.22 in March. And then we've also added to that position, all in an advantageous way. We've taken money off the table, and we've still given ourselves a shot to the upside. What you don't want is a trade that's going against you, and you're just like, well, I'll just buy something similar further out, and I'll sell what I have. And then again, I'm throwing good money at bad, and you don't want that. When you have the cards, we have the opportunity. And that's what we're doing here. Everybody clear? So have the right mindset on when you're going to roll. A lot of people say, well, if this thing starts to go against me, I'll just roll it. Well, you're just adding more risk or more money to the trade that's not working. Don't do that. Nobody's perfect. Every trade's not going to be a winner, but handle that risk with care. All right, so from the perspective of an options trader, which is what we are, we can react to the market movements, and we don't have to close out the position entirely. It's a strategic move broken down several key steps. What do we have on now? That's number one. Number two, what do we think, or what is the market doing? Now, the selection of a new position, that's going to be a case-by-case basis. You can't just there's no algorithmic, here's what you do. But we know in general what we want to do. And then the execution of the role, and then the risk management going on after that, which we manage the same way. Okay, so when there's heightened uncertainty, do we have any uncertainty in the market right now? Anybody trading? I'm assuming you guys are trading. Does it feel like there's uncertainty? Certainly. So when we have these areas of uncertainty as we have right now, Vega becomes more pronounced and reflects in an options price because implied volatility is going up and getting into that kind of rarefied air. So this can happen when we have a market like today, when there's upcoming economic events, like a job report, which we're not going to get until next Friday. JOLTS, which we did not get. I know that we're going to get NFP next Friday. I didn't see if JOLTS is coming out. Or, something like FOMC. That can affect all stocks and the market and implied volatility along with it. No jobs report this Friday, but I did see something that's coming out next Friday. Now, you do have binary events as well, like earnings. Stock might be just sitting here just, doing this, and this, but we have the earnings coming up, and whether those earnings are well received or not well received, we can see moves that are outside of the normal expectation, but maybe not outside of the expectation for that move. But implied volatility is higher because we don't know. Remember, implied volatility doesn't tell us anything about the past. Implied volatility is the market's expectations going forward. And then, no matter what, I don't want to say 100% of the time, but let's say 90% of the time, that implied volatility comes back down, mean reversion. What is F1C, FOMC? The Fed. But you have to keep that in mind. Am I putting on a bigger Vega position to the upside, to the downside? Right now, implied volatility is a little bit elevated, a little bit. Not crazy, but it's not 14. It's more like 19. Actually, 20 right now. It keeps going. Okay, so now when to make your move. Hindsight is everything. But again, we're still talking about the same sort of consideration here. We want to roll when we have the cards. Then the world's our oyster. We can do whatever we want. We can sell out for a profit. We can make it into a new type of trade, and we'll go through a couple of those. Timing's everything. Sometimes you're great at it. Sometimes maybe you're too early. Maybe you're a little bit too late. But knowing when to roll your options, that can be the difference between capitalizing on market moves and then watching those potential profits slip away. And so the way that, usually when we're rolling, I look at it almost like a partial exit. Because why? Because typically when we are making these type of trades on an existing trade, The first thing that we're doing is we're taking some money off the table, just like in VIX. Our VIX trade that we have on. I have to check if anybody got filled on that. They should be filled. But anyhow, you're taking money off the table. So at the very least, you are lowering your cost basis, which means that you are lowering the amount of money that you can lose. And you know what Kevin said, taking profits at 50%. You could do that too. You just have to keep in mind that you can't just take, if you're going to let things go against you 100%, you can't take profits at 50%. It's a strategic move. It allows traders to respond to the market's ebb and flow, ending the life of a position to avoid losses or secure gains. And that's what we're doing. If you're not doing these two things, if you're not taking off losses or taking money off the table, then you're probably not doing it right. And it's a delicate balance, because none of us see into the future. We can only deal with probabilities, not possibilities. So the timing of your decision, very crucial. When you're holding the cards, you should be thinking about either maybe you just exit the position, or what are we looking at? Are we looking at market conditions? Did something change fundamentally in the market that makes us think something different than what we thought yesterday or an hour ago? Of course, things like earnings reports and economic announcements, those are going to be very, very pertinent to the market. Right, the magic 8-ball. Don't do that. Of course, we have technical indicators. Are we coming up to big resistance where we might want to consider, if we were in a long play, we might want to consider taking some money off the table? Remember, we are trying to maximize our potential profits while minimizing our potential losses in any trade that we do. We're not swinging for the fences. We're being very, very proactive and, maybe you could argue conservative. Then you have, of course, your personal investment goals, and then the Greeks that go along with it. All right. In options trading, you're gonna have either a long Vega or short Vega position on. And it's very important that implied volatility does not automatically rise when prices fall. Sometimes it does, like today. We got the VIX at 2020 right now. Now, implied volatility can rise when option price, when the underlying goes up. It can happen. If we get a move, let's say on earnings, that are outside of the market's expectation, it doesn't happen often, but it can. Or if you have, let's say, I don't want to pick on it, but let's say you have, a biopharma stock that you're long. So you're long implied volatility there. And lo and behold, their test through the FDA passes, stage 1, stage 2, whatever it is, and we get a move from a stock that went from $10 to $50. Implied volatility is not going down in that case. Most likely. You always have to put most likely at the end. But it boils down to the uncertainty and to how far up or down we can move. And it's all based on the expectations, right? There's going to be some people that are short options. There are going to be some people that are long options. So most of our spreads, not all of our spreads, we do, a net debit. Long calls, long puts, vertical spreads. We don't really do straddles or strangles, but those would be all Vega positive. We're buying implied volatility in all those times. And it does tend to be very directional, and it looks to profit from an extreme or sharp move that favors those options positions. If IV, implied volatility, increases, that's going to benefit your option strategy. If IV decreases and you're in a debit spread, long Vega positions, they would be affected negatively from an implied volatility standpoint. So traders, and I know that we don't do net shorts in here, but we do iron condors and things like that. They are going to be short Vega. Those would be selling naked calls and puts. We don't do those because most people aren't able to do those. Got to make sure on my time here. Going a little bit long. Vertical credit spreads. That's going to be negative Vega. Short straddles. We can't do those because most people can't. Short strangles for the same reason. But like iron condors and iron butterflies and things like that, we definitely can do. Short Vega traders, they believe that the market is overstating. That's why we have a market. If you think it's cheap, you buy it. If you think it's expensive, you sell it. And that's where the market comes together and we have price discovery. That's why we have markets. So short Vega traders, they aim to profit by selling options because they think that implied volatility and thus the option premium is too high. And then if implied volatility comes down, then they profit off of that. If implied volatility expands, well, short Vega traders, they can show losses. We've seen that in plenty of times. So, adjusting for time decay. If we find ourselves that we're getting and we're in a long and profitable position, but we are paying theta, then we don't want to do that. Let Mike's job get a little bit easier. Our word of the day, top 5. ILL. I don't know if there's any Illini out there. But Scott, Dan, and myself, that's our alma mater. All right, just because Mike's got to get these names on the wheel. So top 5 is our word of the day to get yourself some great prosper swag. Okay, so we have to take in consideration time decay. Are we getting ourselves into a better or worse position as far as time decay? Volatility shifts. How much Vega exposure do we have? Do we have a directional bet on? Do we want to hedge ourselves in one way or another? Either taking something off of the upside, or maybe we even buy some downside. Usually that doesn't happen. Are we generating income from this? Meaning, are we making ourselves in a better position to collect more money? At the very least, we should be looking at taking money off the table. And like I said, hedging, same thing. You can, if we're long something, maybe you roll into, maybe you got some cheap puts or something like that. All right. So again, top 5. All right, that's it for the slides. Let me get rid of this. So let's look at an example. I'll just bring up a little word thing. Let's say, I don't know. I'm whatever the NVIDIA. Where's NVIDIA trading? It's trading. Why? So let's say that we're long the 175, 180 call spread. Doesn't matter what it is. I'm just doing it as an example. I'm not telling you to buy this or anything like that. Yeah, we're down over 2%. Okay. If we rally, and we still like the upside, what could we do? My typing is as good as, what could we do? Remember, remember, we want to reduce risk, or we want to, I'll just say, give ourselves more potential to the upside. So what can we do in this, something like this? Doesn't matter what it doesn't matter what the expiration is, but what could we do? Oh, wheels closed. All right. So in a case like this, so in this case, we have the following. Right? We're long the 175 call. We're short the 180 call. And let's say we paid, I don't know, let's just say $1.50 for this. Okay, what can we do? Remember, we want to lower our cost basis while still, and we still love NVIDIA, even though it's getting its butt handed to it today, while still okay, so we want to lower our cost basis. Well, we can turn this is just an example. We can turn this into a broken wing butterfly. That's one thing to do. Maybe you don't want to roll. Probably an addition as opposed to a roll. So we can turn this into a broken wing butterfly. So we can sell the, hang on. Let's say that NVIDIA does rally, right? We're holding the cards. We can sell, basically, anything against this position. Some things will be better than others. For example, we can sell the 180, let's say 182 call spread. Will we take in money? Or do we have to pay to do that? We take in money. Thus, at the very least, we're lowering our cost basis while still keeping our potential profit. We can keep that. I mean, there's a lot of things that we can do. I'm just trying to throw out one. So then we have on the 175, 180, 182 broken wing fly. We've taken in money. So we've taken money off the table. You can't take any more money than we have out there against us. We already paid for our money up. We paid for the spread up front. NVIDIA rally, not happening today. I'm just using it as an example. And then we sell the 80-82 call spread against it on the rally. So we've taken money off the table. We haven't taken ourselves out of a profitable position if we continue to rally. Those are two good things. Does that make sense? I want to get to, we got to do our wheel of names. I went a little bit long today. Ooh, lots of names in here. Good, good, good. All right, who's ready for the spin? I am. Oh, who's it going to be? Who's it going to be? Wong Tom Chang, 2075. Are you in here? I appreciate that, Bushman. Smash the like, smash the subscribe. That helps us. Young Tom Chang, are you here? Hopefully you're here. Because if you're not here, then we can't do anything. We're going to have to spin again. Oh, come on. Hopefully you're here. All right. Congratulations. Nice work. All right. So just email us at prosperswag@prospertrading.com and we'll get you some cool stuff. We're already done there. Trading Den. All right. Does anybody have any questions before we get going here? And back to this crazy market. And if not, I really appreciate you guys and gals and ladies and gentlemen, depending on where you are on the spectrum, for tuning in here with usually with Scott. Scott was unavailable, so I was more than happy to jump in here. I can say with 100% certainty that the market will go up and down. Yep, that's true. My thoughts on TXN. Let me see here. Let's pull this up. was doing well before. I don't know how it's doing. I really haven't looked at it today. So expectedly it comes down. I mean, it's still bullish. Now where, I mean, you really need, quite a pullback because it went up a lot. I would not be buying it here, even though it's bullish. I think you're buying extended prices. So we wait for value. If it's not there, we'll find something else. But I would say right here at the hall or at the bottom of this earnings gap at about 204.50, let's call it. But right here, I don't want to sell it. I don't want to buy it. And then I assume that you were saying SLB, or were you saying SLAB? I don't know what SLAB is. Were you talking about SLB? Or is that SLAB? I'm not familiar with it. Well, there's another one. It was trading. I mean, if anything, I would say that you want to sell it. I don't think it's particularly liquid. I'm not buying it here. I mean, it only went up 50%, 49.25%. I'm not buying it here. So you need to have some sort of pullback, and a big one at that. If you told me that I had to do something in this, I would say, well, you got to sell it because somebody's going to start taking profits because we were trading 150 less than a week ago, and now we're trading 204, 205. Don't chase these type of trades. I'm not saying it can't go higher. Maybe it goes higher. But also, if I was long from 145 or 150 and it's trading 205 right now to 207.5, I'm selling some of it. But like I said, this is probably not all that liquid. Let me see how liquid it is. I mean, look at it. For February, you have, I mean, we can almost count on our fingers, and I'm being a little bit facetious here. But there is no liquidity, and I don't want any part of it. All right, so everybody, thank you for tuning in. Thank you for supporting us, smashing that button, that subscribe button, smashing that like button. I really appreciate it. It helps us a lot, and we love doing this, and we want to get this more and more outside so everybody else can hear all the cool stuff that we're doing. Okay, yeah, this is absolutely illiquid. I wouldn't touch this with a 10-foot pole. Good luck getting in and good luck getting out. All right, so everybody, thank you so much. Scott, I believe we'll be back with you tomorrow. If not, it'll be one of us cool guys too. All right, so thank you very much. Everybody have a great rest of your trading day. And I'll see you in the short-term options room or maybe even back in here. All right, thank you, everybody. Have a great day.